We've all seen the headlines, right? The Reserve Bank hikes the cash rate, and like clockwork, your mortgage repayments shoot up. You think it's a direct mechanical link. But what if I told you that's not really how it works? Today, we are going to pull back the curtain on this whole story and find out the surprising truth about how your mortgage is actually priced. So, you know the story we're always told? It's simple. The bank's cost of borrowing goes up, so they pass that cost on to you. It's a neat and tidy explanation that, well, it just makes sense. But what if the reality is a lot messier? What if that link between the RBA's rate and your rate isn't as direct as we've all been led to believe?
Okay, so to really get to the bottom of this, we first have to challenge a really basic idea that most of us have about what banks actually do with our money. It's an idea we're pretty much taught from day one.
Now, this might sound a little out there, but stick with me because it's the key to the whole puzzle. We're taught that banks are just intermediaries, right? They take in savings from depositors, and then they lend that same money out to borrowers. But what if that's not how it works at all? What if, when you get a loan, the bank is actually creating brand new money, right then and there? All right, so here is the first major bombshell in our journey. When a bank approves your loan, they're not reaching into some big vault of customer savings. No, they are, in fact, creating new money, pretty much out of thin air, through the very act of lending itself.
So how does this work? Well, it's basically just an accounting entry. When a bank approves your mortgage, they aren't physically transferring any existing money. They just make a few keystrokes on their computer. New entries pop up on their balance sheet. It's not magic, it's just modern banking.
Let's break this down. The second your loan gets the green light, two things happen at the exact same time. First, the loan itself becomes an asset for the bank. That's money you now owe them. But at that same instant, a deposit for the exact same amount appears in your bank account. And that's a liability for the bank. It's money they technically owe you. Both sides of their ledger just expand instantly. Now, I know what you might be thinking. This sounds a little out there, right? But this isn't some fringe conspiracy theory. The Reserve Bank of Australia has said this explicitly. As you can see right here from their bulletin in 2018, they confirm that the act of extending a loan is what creates the corresponding deposit. It actually expands the money supply.
And they didn't just say it once. The RBA has hammered this point home a few times. Just a couple months after that bulletin, the assistant governor, Christopher Kent, was even more direct. He just came right out and said it. Banks create money when they make loans. So this isn't some secret, it's a publicly acknowledged fact of our banking system.
And look, if you're still not convinced, here's the final nail in the coffin. This is a direct admission from the CEO of Australia's biggest bank. At their 2022 AGM, CBA's Matt Coman stated clear as day that they expand the money supply when they lend. I mean, you can't get much clearer than that. So case closed, right? Well, not quite.
So if this is a known fact, why isn't it common knowledge? Well, part of the problem is that even at the very top, there seems to be, well, a bit of a debate, or at the very least, some really confusing statements being made. And this is where it gets really murky for most people. On one hand, you have the CEO of the country's biggest bank saying, yep, we create money. But then you have a former RBA governor saying it's just not true that a single bank can do that. This apparent contradiction from the highest levels is exactly why this whole topic feels so confusing. So, how do we solve this puzzle? Well, to get some clarity, we need to forget about the loan for a second and just focus on what the RBA cash rate actually does. Its real job is way more specific than most people think.
The best way to think about the cash rate is like the plumbing of the banking system. At the end of every single day, all the banks have to settle up their accounts with each other, for all the transactions we all make. If one bank is a bit short on cash to settle its books, it can borrow from another bank that has a surplus, just for the night. The cash rate is simply the interest rate for those loans. It's all about managing liquidity between the banks themselves.
Okay, this is so important to get your head around. There are two totally separate things happening. First, there's the creation of your loan. That happens between you and your bank instantly. Then, later on, there's the whole interbank settlement process, which happens between all the banks. The cash rate only applies to that second process. So here it is, the crucial point. The bank does not borrow money at the cash rate in order to give you your mortgage. Let me say that again, because it's the most important takeaway here. The money for your loan was created out of thin air, remember. The cash rate is a totally separate operational cost for them, about managing their books overall. It is not a direct cost of funding your specific loan. And this, my friends, is where it gets really interesting. Because if the cash rate isn't mechanically tied to the creation of your loan, it begs a massive, massive question.
Right, so if it's not the cash rate, then what is it? When your bank raises your mortgage rate right after an RBA announcement, what's the real reason they're doing it?
It's a commercial decision, pure and simple. The banks choose to follow the RBA signal. They aren't forced to. Their pricing is based on, well, their own target profit margins, the level of competition in the market, what the other big banks are charging, and of course, your personal credit risk. The RBA's announcement just acts as a really convenient signal, or excuse, for all of them to adjust their pricing and protect those profits.
But is there any proof of this? You bet there is. And it comes straight from Australia's competition watchdog, the ACCC. In a recent review, they found that the major banks have an accommodative and synchronized approach to their pricing. In other words, they don't really fight each other on price, they all tend to move together. And why do they do this? Well, the ACC says it's because of the market structure itself. Australia's banking scene is basically an oligopoly, dominated by just a few massive players. And in a market like that, starting an aggressive price war just hurts everyone's profits. So it's much better for them to accommodate each other's price moves instead of trying to undercut each other.
So let's just pull all this together. The idea that your mortgage rate is directly and mechanically tied to the RBA's cash rate, it's a myth. Banks create new money when they lend. The cash rate is an operational tool they use amongst themselves. And your mortgage rate? That's a commercial decision, made in a market where the big players all move in lockstep. This means the power to price the money they literally create rests firmly in their hands. So the final question we're left with is this. In a system where banks can create money and then decide how much to charge for it, what does that mean for you?